Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what are we talking about? Well, obviously I want to continue to talk about surviving and prospering during a bear market. And basically that means not letting the market beat you. That'll make a lot of sense in a few minutes. Signs, signals, and understanding trends. I want to rehash a lot of things we've been talking about as of late and get you ready just in case this turns into something much more than it already has. I want to then talk a little bit about the methodology in action. Actually, we'll do that first. We got a couple of mystery charts this week, and believe it or not, they're longs and surviving and prospering from a spanking. That'll make a little more sense, hopefully in a few minutes. By the way, housekeeping, I do take requests. If there's something you want me to cover, shoot me an email. You can reach me at davelandry.com/contact. It makes my job a lot easier. As I say each week, if I can't fit it into this venue, which is somewhat limited in time, I can cover it on Thursday night in Dave Landry's The Week in Charts. You can go to davelandry.com/webinar to register. Register if the link or the date is old on that, because it will give you access to upcoming shows. If you want the slides from this presentation and every other presentation that I've done for Trading Simplified, for StockCharts.com, that is, StockCharts TV, I suppose, go to davelandry.com/stockcharts, and that has all the patterns and setups, mystery charts, etc. that I talk about. And you can go in and see how the mystery charts work, or didn't work, warts and all. All right, let's talk about a couple of mystery charts here. First of all, this stock is a buy, and this is based on a 100K account. This is a snapshot of the portfolio I took this morning. Open portfolio that is, and it's again based on 100K account. I have hypothetical in here, but I do actually take these trades. Anyway, you can see nice uptrend, really nice uptrend. In fact, it's an accelerating uptrend. Notice that it worked its way higher, then it began to accelerate higher. Nice deep pullback, and then also notice that the trend higher was a very persistent one. And I think I did a show probably a year ago on persistent pullbacks, where you're looking for persistency, which means the market tends to go up day after day after day. Mathematically, that's equivalent to linear regression, but I just prefer to draw a line through as many bars as possible. So that's what a linear regression trend line would look like. Again, I just eyeball it and draw a line through the chart. So based on the spreadsheet I just showed you, here are the parameters: entry around 12, stop down here, initial profit target up here. Should it trigger in? And the mystery chart from last week did not trigger. That's FAST, F-A-S-T. It's no longer a setup for those keeping score. So no capital was put in harm's way. It was a short, but it continued to rise. But anyway, if this does rise enough to trigger an entry at 12, then our IPT is up here around 15 and a half, right around the old highs. It just happened to work out that way. And then obviously a stop down here, because occasionally we are wrong. Our second mystery chart, another good looking chart, especially given the nature of this market. Here are your parameters: entry 25.50, stop 20.50, initial profit target of 30.5. So that's 5-point risk on this particular trade. And it showed the corresponding shares for a 100K account. Once again, you can see nice uptrend intact here. And this one also was fairly persistent and also began to accelerate higher. Nice deep pullback, entry here, stop right here, initial profit target. Remember, we're going to sell half of our shares should that hit, and our stop will be moved to break even at that point. And then hopefully, a word that's somewhat dangerous in this business, but hopefully we're with the position for a long, long time. And I'll follow up on those two in upcoming presentations. Now, this was a former mystery chart. Actually, I showed it while it was still a setup. It did trigger for my people via the trading service, but it's still a good-looking stock, and I did show it as not a mystery chart because it had already triggered a few days earlier. But anyway, we had a bow tie back here. Those are parameters up there, by the way. And our entry was here, stop was down here, initial profit target was here. It took a while to hit it, but thank goodness it did. And then we trailed our stop higher. Now, one thing with the trailing stop is you let that widen out over time. Go in and watch the money management shows that we've done in the past, or take the money management module on the back end of the website. FYI, you do have to be a gold member for that, but it's cheap. Anyway, a little shameless plug there. But notice that it did kind of nick that stop, and last week I showed you why I decided to stick with the position in that particular case, and that's a little bit of discretion. I'm going to show you some discretion here, too, on surviving a damage control situation. But anyway, here's the trades that I took. I started off with 3,000 shares in this one particular account. I did take it across multiple accounts. And then here's where I exited half. And then at the IPT, obviously. And again, I held through this little stop nick here, exited another 500 shares. I just felt like it was a gift horse. And then when I left off, I was up about 54.80 on the remainder of the position in that account. Now, let's shift gears for a second and go to trading maybe slightly more complex. As you get better and better with trading, you can begin to apply a little bit of discretion to these things. So let's say I show you a setup with the exact entry, the exact stop, the exact IPT. There might be some cases where you get a little bit of an opening gap reversal, so you might want to enter slightly higher as opposed to entering right at that entry. You might have a stop nick like I just showed you, or, God forbid, you might end up with a damage control situation. But sometimes those damage control situations could actually turn out okay. Now, this one pre-market was trading down a couple of bucks, and for a $10 stock, that's a pretty big hit overnight. I got a text from one of my clients telling me, hey, have you looked at this? I'm like, oh, geez. Or as we say in Fargo, oh, geez. Anyway, so here's what I actually did with the trade. I actually did an add-on trade, which could be quite dangerous, but I want to explain to you exactly my thinking. Now, again, this is where it ended up opening down a few bucks, okay? And then it began to rally. Now, this is what I call an opening gap reversal. And you do want to play these in the direction of the trend. And ideally, if a market has pulled back a little bit and then you get a gap down and a pullback, that could actually make for a wonderful opportunity. Now, if this was just a damage control situation in and of itself, you hang on through the open and you have an uncle point in mind. Notice that it dipped a little bit on the first 15 minutes. This is a 15-minute bar, by the way, before reversing nicely. Now, I didn't want to get faked out, so I waited to do my add-on trade, and I added on 400 at this level here. And then I decided to use a 1-point trailing stop, which gives me a 1-point initial profit target for half of the shares. And you can see that after holding on for most of the day, it did rally to hit the initial profit target. At that point, I exited 200 of those shares. And then on the close, I exited the remainder. So 200 times 1 point obviously is $200. And then 200 times $1.47, based on the closing price, equals $294. So I was able to pick up $494 on the trade. Now, I started the day down $2,100, and again, I had this across multiple accounts, so I was a hurting pup on the open, and it was hard to implement this plan, this damage control plan, which meant, again, letting the stock open, be willing to give it a little bit of wiggle room, have an uncle point in mind just in case it doesn't work, and then in this particular case, removing myself from the situation, I saw that it was possibly not only it was a bad thing, but it was possibly an opportunity to make a little bit of money back should this turn into the mother of all reversals. Now, I'm not averaging down. This is a standalone day trade strategy where you're looking to play those opening gap reversals. If you are a gold member of DailyLearner.com, I talk a lot about opening gap reversals. It's usually something that I don't cover a lot in these shows because it's a little bit more advanced, but they can be very lucrative, as you can see here. Now, as of the close, the position was actually up 25.30 plus the 494. So for the day in this one stock, I ended up 3,024, and that was based on 100 share residual position. Now, again, started the day pretty ugly, ended the day much better. So that turned into a $5,124 equity swing. Easy, huh? I wish. Settle down, Beavis. Damage control can often work quite nicely, but you have to have an uncle point in mind. And you already have the loss, work to improve upon that. And I remember many, many years ago, I was blessed to have a futures broker, and he was mentored a bit by some very famous well, one in particular, a very famous trader, and he learned a lot from him, and he would actually pass down some of that knowledge to me. And he'd say, Dave, you already have the loss. Let's see if we can work to improve upon that. And a lot of times you'll have these big old fat opening gap reversals, which are absolutely wonderful. Now, if you're going to do an add-on trade, they can pay off nicely, but they could also add insult to injury. So I was risking 1 point on 400 shares, and again, across multiple accounts. But in this one particular example, I would have lost another $400. And that would have been, let's say, $2,400 plus whatever the uncle point is, plus another $400. So that could have been pretty darn ugly. And it is pretty hard to keep your head when and take that 30,000 foot view. It's hard to keep your head when you're getting beat up really bad like that. So I don't want to make it look like this is an easy thing to do, but if you can remove yourself from the situation and just kind of look at it from an antiseptic viewpoint, kind of a detached viewpoint, then you can do quite well with these. And the other thing, again, if you look at it as a setup in and of itself, an opening gap reversal trade, and if you were just seeing that for the first time, forget about the fact that you got whacked overnight. If you were just seeing that for the first time, would you go in and trade that trade? As I've said 1,000 times, last summer when the market was making all-time highs, I think somewhere late August, around the 25th, if memory serves, I decided to do a show on market timing. And that's because friends and family don't bother calling me until they're down about 40 or 50%. And then after that point, the bomb has already blown up. It's too late. So market timing is something you definitely have to get ahead of. So the question is the bomb now blowing up? And my answer is it might be. Now, when I tell people markets go up and markets still go down, as I preach, they look at me like I pooed in my pants. But when they start going down, they tend to justify and reason, and they just don't want to believe what they see. And as I said a couple of weeks ago, when I first received a TFM 10% signal, which I'm going to show you in 1 minute, but this was based on a rolling basis, I explained to a friend of mine, and I said to him, you might want to talk to your guy, and he says, I did. And I'm like, okay, what did he say? He says, well, he's getting more aggressive now the market has dropped. And I'm like, oh boy. And I must have rolled my eyes or something. And he says, hey, my guy's made me a lot of money. So he got really defensive really fast. Now, just last week, my wife was talking to a friend of hers, and she was telling Marcy, my wife, about how her husband was struggling a little bit with his trading. And she said, well, has he asked Dave for help? And he says, well, he said that Dave won't help him. And that's not true because, number one, I gave him access to the back end of the website, the gold membership. I also gave him membership to the core trading service. And then I looked to see when he last logged in, and it's been a couple of years. And when we last talked, he was buying a stock that was dropping and dropping and dropping. He kept buying more, buying more, buying more, buying more. And then the stock turned into a pink sheet stock. So it's not that I won't help him. It's just that he doesn't want to hear what I have to say. Now, the reason I did the whole before the bomb blows up, again, is because once the market is down 40 or 50% or more, that's when my phone begins to ring and people say, Dave, what do I do? So the point I'm trying to make is you really have to get ahead of it. And before we go any further, just realize I don't want a bear market to occur. I'm just the messenger. I would much rather trade a bull market. It's far more easier waking up every day, seeing how much money you made, instead of fighting the short positions that go sharply against you, knock you out, and then the market, of course, rolls right back over. Anyway, earlier I talked about a calendar versus a rolling signal. ACP, I'm fairly sure, uses a calendar chart. So this is as of last Friday. So each bar ends on a Friday. And what I mean by that is if you're looking at it on Thursday, it'd be Thursday to Thursday, Wednesday to Wednesday, Tuesday to Tuesday, and Monday to Monday. That would be a rolling basis, okay? Anyway, the reason I'm bringing that up is 2 weeks ago or 3 weeks ago, we had a signal with the TFM 10% system, but that was on a rolling basis. But now it's official. If you want to learn more about that, if you go to my website, and I just added this in over the weekend, bear market updates, you're going to get the latest things that I'm talking about, latest content, videos and such, and explaining a lot of these things. And this is what we're talking about right here, this TFM 10% sell signal. And just to kind of give you a little thumbnail on that real quick, this right here is a 10% line. This is the ACP plugin, which is free. If you have Stock Charts ACP, you can get the plugin for free. All you need to do is like this video, and the plugin is yours, absolutely free. I'm not sure why I give it away, but maybe one day I'll charge, but it's free now, so get them while they're free. Anyway, you can see that it closed below this 10% line. This is just 10% away from this 50-week closing high. And this is a 50-week moving average. Any close below both of those is a sell signal. Now, as I say quite often, market timing is less about beating the market and more about not letting the market beat you. The point I'm trying to make there is occasionally the market loses half or more of its value, and it could be very tough to lose that much money, especially when you need it, such as late in life and near retirement. And even earlier in your investing or trading career, it would be pretty cool to avoid such a nasty drawdown or diaper change moment, a term I've stolen from Ian McActivey. Anyway, as I've showed you 1,000 times, this is some of the ugliness that happens once a market gets 10% or more away from its 52-week high. Obviously, the Great Depression, market was down about 80%. And in 2009, obviously, we're down over half, 50%. And the NASDAQ back in 2000 was down, I believe, 77%. And of course, it dropped 10% before it continued to drop. Now, one thing to remember is, if you don't remember the last couple of bear markets, just because you haven't lived through something doesn't mean it can't happen. I would urge you to go in and look at some of these charts historically, specifically the indices. Now, everybody's going to get pretty excited pretty soon. You're going to hear the word death cross. And I would never trade something like a death cross in and of itself. Death cross is when a 50-day simple moving average crosses below a 200-day simple moving average. And you can see we just got one of those recently in the S&P 500 as of the 14th. Now, if you were to trade these in and of themselves, you probably wouldn't make a lot of money because there's a lot of lag involved. However, especially if you're waiting, obviously, for the golden cross to happen, for that 50 to come back up above the 200-day moving average. But the reason I'm showing it, one, is because it's a popular thing, and you're probably going to hear a lot about it soon. But two, like any signal, it's the magnitude of what happens next that's concerning. So if we zoom in back in 2008, you can see the 50 slice through the 200-day moving average, creating the so-called death cross. And if you take a look at what the market did, it actually bounced a little bit before it started to really sell off. But it sold off for a long, long, long time. And during that period of time, it lost 55% of its value. Now, it rallied significantly before the moving averages crossed back over. So again, I wouldn't use that for timing in and of itself. But when you see a TFM 10% sell system and possibly bow ties to the downside or Landry Light to the downside, which I'm going to discuss here in just one second, you might want to think about getting out of the way. Certainly honor your stops on any longs. Certainly be super duper selective and only go after, here's a hint, energies and metals and mining, like those two mystery charts I just showed you, which right now are trending higher. Let me rewind that a second. Don't just go after metals and mining and energies in a bear market. Do go after them if they're going up. Now, I just want to touch upon a few of these trend concepts that I kind of beat the dead horse on. This is what I call Landry Light. And to the downside, it simply means that the highs are less than the moving average. There's light, so to speak, in between the high and the moving average. And you can see here I drew a trend line underneath, or a line underneath. We did have a couple of kisses of, and this is a 30 EMA. This is my favorite EMA, the 30 EMA. I'm sure you want to party with me. At least recently it has been. Anyway, you can see lots of red here. When it goes up to kiss the moving average, it goes to 0. If the low becomes above the moving average, if you squint your eyes right here, you can see it turns green. Now, the point I want to make is if you follow a market and it's mostly green and things in general are okay, if it turns red, then things might be getting a little bit iffy. So if we go way back in time, you can see we're mostly green way back on this chart, going back a couple years. We did have a bit of a slide in 2019, as you can see, and that would be a good time, again, when you start seeing some red, to honor your stops, maybe think about a short or two if you're a little bit more advanced, and certainly think about where you want to be longer term in the market. The market did go back green, and then obviously on the 30 EMA turned red during the pandemic, during that pandemic bear market. And we've been mostly green ever since, of course, until recently. So it's not the end of the world, nor can you see it from here, but you might want to start paying attention when you start seeing signs and signals like this. Let's take a look at a weekly chart with the 50-week moving average. And this is the average I use for the TFM 10% system. You can see we had a little red way back here in 2011. It was green for a long time, all the way up to around 2016. So that would be a good time to be long. Obviously, it turned red. And I remember this slide up in here, and it was a pretty ugly slide. So it's a lot uglier than this chart would suggest. And you can see mostly green again, a little red again in 2019, as we just showed a minute ago, or as I showed a minute ago. Me, myself, and I guess. Red again during the pandemic, okay? And then green ever since, and now red once again. So we need to pay attention to these, again, signs and signals. Now, bow tie proper order, meaning the 10 simple is greater than 20 exponential. The 20 exponential is greater than 30 exponential for upside or uptrends. And just the opposite for downtrends can help to keep you on the right side of the market. So again, mostly green. Go in and watch the shows that I've done where I do Tarzan speak. Green, good, okay? Red is bad, obviously. And you can see we did have a little spill back here. Mostly green since, okay? And then notice that the bow tie formed when the moving averages come together and spread out. Notice you go from green, you have a little bit of yellow, and then a lot of red. And notice that the market has been in a pretty serious slide ever since. So I would pay, again, careful attention to these signals. If you take a look at a weekly chart, now the weekly bow tie, by the way, can be slow to turn, okay? But if you get a gradual rollover in the market, sort of like what we have now, and you can see it over here, it's coming together, and it's not quite red just yet. It's yellow, and I'll show you what that means. But again, moving averages sometimes will have a lot of lag, which isn't always a bad thing. Sometimes that can help you stay in the market and avoid whipsaw, but you don't necessarily want to sit around and wait for a weekly signal, because by the time it flipped over, for instance, in the pandemic, the market had already bottomed and was on its way back up. So a V-bottom does not really work great with moving averages. Now, if we zoom in on the weekly chart, you can see, obviously, we're green for a long, long time. And we were still green even though the market began rolling over. And again, you're going to have some lag in a moving average type of crossover system like this. And you can see we're now yellow because the 10-day simple moving average has crossed below the 20 and the 30 simple moving average. And you can see those moving averages come together and should cross over the next few weeks. A couple of random thoughts. Last week I showed that it takes a while sometimes for a market to roll over, and in general, a market a market doesn't just make all-time highs and then implodes. You do have some time, but you're not going to have unlimited time. So like today is a really good up day in the market. That doesn't mean that everything is over, but it does help you think about where you want to be longer term and whether or not you should be exiting the market. Retrace rallies will suck a lot of people in and make everybody think that all is good in the world. I would use them to lighten up a little bit, provided that you need to be out of your positions rather than as an all clear. And never forget, he who fights and runs away lives to fight another day. The other thing, too, is like my aforementioned friend whose financial guy was buying more because it was low. And I hope he's right, but he might not be. One thing that I've seen before, and quite often, is it's always darkest right before it gets more dark. The NASDAQ was down 50% in 2000, and then it dropped another 55% from there. Well, that's all my time. I want to thank you for watching. If you have any questions or would like some follow-up information, davelandry.com/contact. Again, if you need the slides and a bunch of other stuff that I forgot to mention, such as all 3 of my books in PDF format and limited access to the members area. Also a market timing course. You can go to davelandry.com/stock charts. So I want to thank everybody for watching, and may the trend be with you.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.